Equity Research Interview Preparations Guide for sell-side and buy-side teams. If you are preparing for equity research roles on the sell side or the buy side, this video is built exactly for you. We have created very comprehensive interview preparation material, specially designed for equity research teams, not just accounting theory or generic valuation shortcuts. In this session, we go deep into how equity research actually works in the real world. From financial modeling and valuation to industry analysis, earnings interpretation, stock pitching, and communicating ideas to investors. You will learn how interviewers expect you to explain company fundamentals, growth drivers, competitive positioning, DCF and multiples, and why a stock should outperform or underperform, clearly, logically, and with conviction. Explain the role of an equity research analyst and how it differs from that of an investment banker. An equity research analyst evaluates companies, builds models, writes reports, and gives investment recommendations, usually buy, hold, or sell. Your job is to understand a company deeply and tell investors what the stock should be worth. An investment banker advises companies on deals, mergers, IPOs, financing. Bankers work on transactions. Equity analysts work on valuation and insights. So think of equity research as explaining value, and investment banking as creating or monetizing value through deals. Walk me through how you would build a financial model for a company starting from scratch. Start with historical financials, income statement, balance sheet, cash flow. Clean the data and understand key drivers. Next, build the revenue model. Then forecast operating costs, margins, working capital, and capital expenditure. Link everything into pro forma financial statements. Finally, build valuation modules, DCF, multiples, and sensitivity analysis. A good model is transparent, well-structured, and easy to audit. What are the key components of a revenue model, and how do you forecast revenues across different industries? Revenue modeling begins with two ideas: volume and price. Depending on the sector, you break revenue into drivers: telecom, subscribers, churn, ARPU; airlines, load factor, passenger miles, ticket price; retail, store count, same-store sales, basket size; software, seats, subscription tiers, retention. You forecast each driver realistically, often using trends. Management guidance and industry KPIs. Describe how you calculate a company's intrinsic value using a DCF model. First, forecast free cash flows, operating cash flows minus capital expenditure. Next, discount those cash flows using the weighted average cost of capital, the WACC. Then compute terminal value, either via perpetuity growth or exit multiple. Finally, sum the discounted cash flows and terminal value to get enterprise value, adjust for net debt, and divide by share count to get equity value. DCF looks forward. It values the future rather than the present. How do you select peer companies for relative valuation analysis? Peers should share similar characteristics: industry, business model, geography, size, and growth stage. For example, you do not compare a fast-growing cloud SaaS company to a slow-growth hardware manufacturer. Sometimes you select multiple peer groups: global peers, regional peers, and aspirational peers. The key principle is comparability. Walk me through the steps of preparing an equity research initiation report. An initiation report begins with a clear investment thesis: why the stock is worth more or less than the market thinks. Then you explain industry overview, company fundamentals, financial forecasts, valuation methods, and a full risk section. You include charts, KPIs, competitive analysis, and scenario work. The initiation is long because it sets the foundation for ongoing coverage. A company beats earnings, but the stock falls? How do you analyze and explain this reaction? A stock can fall even after strong earnings because markets react to expectations, not just numbers. Possible reasons include disappointing guidance, margin pressure, weak cash flow, slowing growth, or one-time gains masking weakness. You analyze call commentary, forward-looking metrics, and market sentiment. Earnings are about narrative as much as numbers. Explain the difference between top-down and bottom-up analysis. Top-down starts with macro trends, GDP, interest rates, sector growth, and narrows down to the company. Bottom-up starts with the company itself, its products, margins, cash flow, and builds upward. Good analysts blend both. Top-down for context, bottom-up for specifics. How do you analyze the company's competitive positioning within its industry? Use frameworks like Porter's 5 Forces, market share trends, cost structure analysis, and product differentiation. Look at brand strength, pricing power, barriers to entry, and customer switching costs. A strong competitive position shows up in stable margins and high returns on capital. Describe the purpose of management meetings and what types of questions you would ask. Management meetings give you insight into strategy, priorities, risks, and culture. You ask questions like, where is growth coming from? What is your pricing strategy? What keeps you up at night? How do you think about capital allocation? The goal is clarity, both for your model and your thesis. How do you incorporate macroeconomic trends into your stock recommendations? Macroeconomic variables affect demand, costs, and valuation. If rates rise, discount rates rise, lowering valuations. If inflation rises, input costs rise, squeezing margins. You assess whether the company's cyclical or defensive. Then, adjust forecasts, multiples, and risk premiums accordingly. Macroeconomics provides the backdrop for your recommendation. Walk me through how you analyze a company's historical performance and identify red flags. Start with revenue growth trends, margin patterns, working capital cycles, and cash conversion. Red flags include sudden margin spikes, unexplained revenue jumps, inconsistent cash flow, rising receivables, or frequent one-off adjustments. Look for sustainability, not just performance. History often hints at future risk. Explain how you forecast operating margins and what factors influence them. Margins depend on pricing power, input costs, scale, efficiency, and competitive intensity. You examine historical trends, industry benchmarks, and cost structure. Then test drivers, revenue growth, cost of goods sold, operating leverage. Margins rarely move in straight lines. They reflect business dynamics. A company has declining revenue but rising EPS. What could be driving this? Several factors may explain it. Cost cuts that improve margins. Share buybacks reducing share count. One-time gains. Mix shift toward higher margin products. Accounting adjustments. Rising EPS doesn't always signal healthy growth. You must check whether improvements are sustainable. Describe how you evaluate a company's capital allocation strategy. You review how the company uses its cash, reinvestment, dividends, buybacks, or acquisitions. You ask, are investments generating high returns? Is management prioritizing profitable growth? Are buybacks done at sensible valuations? Good capital allocation compounds value over time. Poor capital allocation destroys it quickly. Explain how working capital trends affect free cash flow. Working capital includes receivables, inventory, and payables. If receivables rise or inventory builds, cash flow falls. If payables rise, cash flow improves temporarily. Free cash flow improves when working capital turns faster. Working capital discipline is often a strong signal of execution quality. Walk me through how you perform sensitivity and scenario analysis in valuation. Sensitivity analysis varies one driver, such as discount rate or margin, to see how valuation changes. Scenario analysis varies multiple drivers simultaneously. For example, bull, base, and bear. These tools show investors the range of possible outcomes and the key assumptions behind your thesis. How do you assess the impact of industry-specific KPIs? For example, ARPU, churn, occupancy rate, store count. Industry KPIs reveal business health more directly than GAAP metrics. For example, in telecom, churn predicts future revenue. In hotels, occupancy and RevPAR drive margins. In retail, store count and foot traffic matter. You build KPIs into your model to forecast revenue and margins with greater precision. And a new competitor enters the industry. Describe how you adjust your model and thesis. First, assess market share impact. Will pricing weaken? Will customer acquisition costs rise? Then adjust revenue assumptions, margin expectations, and capital requirements. Update your thesis to reflect a more competitive environment. Competition usually reduces valuation unless the company has strong differentiation. Explain how you interpret management guidance and reconcile it with your forecasts. Management guidance is directional, not exact. You evaluate its assumptions, compare them with your own model, and test for conservatism or optimism. If your forecasts differ significantly, justify why. Perhaps you believe costs will be higher or demand slower. Your job is independent analysis, not blind acceptance of guidance. What are the most common valuation multiples used across sectors, and how do you choose the right ones? Different sectors rely on different economic engines, so you match the multiple to how value is created. Common multiples include price to earnings, suitable for mature, profitable companies; EV to EBITDA, used when capital structure varies across peers; EV to sales, useful for early-stage or loss-making companies; price to book, often used in banks and insurers; PEG ratio, PE divided by growth, used for growth stocks; industry-specific multiples, such as PPOP, pre-provision operating profit for banks, or price per subscriber in telecom. You choose the multiple that best reflects how investors compare businesses in that industry. Describe how you analyze company earnings releases and identify the most important details. Start with headline numbers, revenue, EPS, and margins. Then compare to consensus expectations. Next, dig into segment performance. Which products or geographies drove growth? Review cash flow, working capital, and capital expenditure. Check guidance changes. Companies often use guidance to reset expectations. Finally, read management commentary for tone, confidence, and forward-looking insights. Numbers tell part of the story. Commentary tells the rest. How do you prepare for an earnings call, and what would you focus on? Before the call, study your model, the latest earnings release, and consensus expectations. Prepare a list of specific questions tied to your thesis, not generic ones. During the call, listen for drivers of performance, guidance clarity, margin outlook, new risks or delays, tone and confidence of management. After the call, adjust your model quickly and publish fast, accurate commentary. End. A company announces a major M&A deal. How do you assess whether it is value accretive? Start by analyzing the strategic rationale. Does it increase scale, reduce costs, or expand into new markets? Next, build a simple merger model. Estimate revenue synergies, cost synergies, financing costs, and integration risks. Compare deal value to what the acquired company is worth standalone. If EPS increases, returns exceed cost of capital, and synergies are realistic, the deal may be accretive. If not, the deal risks destroying shareholder value. Explain how to analyze share buybacks, dividends, and capital structure in the context of valuation. Share buybacks reduce share count and can boost EPS, but they only create real value if shares are repurchased below intrinsic value. Dividends signal cash flow strength and attract certain investors, but they reduce reinvestment capacity. Capital structure affects the cost of capital. Too much debt raises risk. Too little debt leaves efficiency on the table. You assess whether management's capital choices align with long-term value creation. How do you detect earnings manipulation or aggressive accounting practices? Look for red flags. Rising receivables while revenue is flat. Large or recurring one-time adjustments. Capitalizing costs that should be expensed. Unusual inventory buildups. Divergence between net income and cash flow. Tools like the Benishine M-score or accrual ratio analysis help quantify risk. Aggressive accounting often shows up in the cash flow statement before it shows up in earnings. A stock is trading at a low PE ratio. Describe how you determine if it's undervalued or a value trap. Low PE can signal opportunity or danger. You check. Growth outlook. Is revenue shrinking? Industry disruption. Is the business model deteriorating? Balance sheet. Is leverage too high? Margins. Are they stable or falling? Free cash flow. Is it healthy? If fundamentals are stable and sentiment is overly negative, it may be undervalued. If fundamentals are decaying, it is likely a value trap. Explain the role of risk factors in an equity research report and how you identify them. Risk factors help investors understand what could alter your thesis. You analyze risks across categories: operational risks, regulatory risks, competitive risks, supply chain risks, and macroeconomic risks. You also test sensitivities. If margin assumptions are fragile, that becomes a risk. Clear risk disclosure adds credibility to your analysis. How do you estimate the cost of capital, and what factors influence it? WACC blends the cost of equity and cost of debt. Cost of equity often comes from CAPM, risk-free rate, beta, and equity risk premium. Cost of debt depends on credit spreads and tax rates. Factors influencing WACC include leverage, market volatility, interest rates, and company-specific risk. A lower WACC increases valuation. A higher WACC reduces it. Describe how you approach coverage of a company operating in a cyclical industry. Cyclical industries rise and fall with economic cycles. So, you model revenues through cycle averages rather than straight-line growth. Stress test margins and cash flow under downturn scenarios. Monitor demand indicators, housing starts, commodity prices, shipping rates, or industrial production. Your thesis must explain where we are in the cycle and how the company handles downturns. A sudden regulatory change impacts the sector. How do you update your recommendation? First, quantify the direct financial impact. Revenue caps, higher costs, fines, or compliance expenses. Next, assess second-order effects, competitive shifts, pricing changes, or slower industry growth. Update your model, valuation, and risk section. Finally, adjust your recommendation based on the new economics. Regulation can reshape a sector overnight, so clarity and speed matter. How do you analyze insider transactions and institutional ownership trends? Insider buying often signals confidence. Insider selling may or may not be negative. It can simply reflect diversification. Institutional ownership shows who supports the stock: long-only funds, hedge funds, or passive investors. Sudden changes in ownership can foreshadow re-ratings or volatility. You interpret trends carefully, not mechanically. That. Explain how ESG considerations influence equity valuations. ESG, environmental, social, and governance, affects long-term risk and returns. Poor governance raises fraud risk. Weak environmental practices raise cost of capital or regulatory risk. Strong social practices attract talent and customers. ESG influences valuation through cash flow durability, margins, risk premium, and investor demand. How do you think about terminal value in a DCF, and what assumptions do you test? Terminal value often represents more than 50% of a DCF, so assumptions must be realistic. You test long-term growth, usually tied to GDP or industry growth. Long-term margins, sustainable, not peak cycle. Discount rates reflect long-term risk. If small changes in terminal assumptions dramatically shift valuation, highlight this in sensitivity analysis. Describe the process of writing a stock pitch and what makes it compelling. A strong stock pitch answers 3 questions. What's the story? What's the value? What's the risk? Start with a clear thesis. For example, market underestimates margin expansion. Provide evidence, KPIs, model forecasts, valuation upside. Add catalysts, earnings, product launches, regulation, or cycle turns. A compelling pitch is focused, data-driven, and easy to grasp. A stock in your coverage suddenly drops 20%. What's your immediate research process? First, understand the cause. Earnings miss, guidance cut, regulatory news, or macro shock. Check whether the move matches the change in fundamentals. If not, it may be sentiment-driven. Speak with management if appropriate, update your model, and reassess your thesis. Your goal is to provide fast, clear insight to clients. How do you manage and track multiple companies under tight reporting deadlines? Use structured workflows. Create templates. Automate data polls. Set calendar reminders. And maintain organized model files. Prioritize by catalyst importance: earnings, events, or rating changes. Good analysts work systematically. Consistency and preparation reduce last-minute stress. Describe a time or hypothetical scenario where your investment thesis was wrong and how you reassessed it. Here is a clean hypothetical. You expected margin expansion from cost cuts, but supply chain inflation offset all improvements. You revisit assumptions, revise forecasts, and adjust your rating. You explain clearly what changed and why. Strong analysts course correct quickly and transparently. What types of alternative data do equity research analysts increasingly use, and how do you validate it? Alternative data includes satellite imagery, web traffic, credit card spending, app downloads, hiring trends, or shipping data. To validate it, compare trends with reported financials, test seasonality, ensure coverage breadth, and confirm data stability. Alternative data enhances insight, but must be used responsibly. Explain how you present your research to sales teams, traders, and institutional clients effectively. Tailor the message to the audience. Sales wants a punchy thesis and clear talking points. Traders want catalysts, risks, and market sentiment. Institutional clients want depth, model drivers, valuation, and long-term trends. Use simple visuals, emphasize key drivers, and speak with confidence. Effective communication is often as important as strong analysis. Equity research is not about predicting stock prices. It is about understanding businesses better than the market. This was a complete, end-to-end interview preparation guide created specifically for equity research roles across sell-side and buy-side firms. If you followed this entire session, you now understand how analysts value companies, how investment theses are built, how risks are assessed, and how research insights are communicated to clients and investors. Rewatch the model building, valuation, earnings analysis, and stock pitch questions. Practice explaining them clearly, because structured thinking and clear judgment are exactly what equity research interviewers evaluate. For more deep, role-specific preparation across equity research, investment banking, risk, and markets careers, stay connected. And once again, do watch, revise, and master this material.